Back to closing trades right here on ET now, and what a interesting off-cam interaction happening with Nitin Bhasin. But let's take it on cam and let's help our viewers as well benefit from all the insight. Nitin, great to have you in ET now studios.
Thank you.
Such a seesaw of a market and such a, I don't know, tug of war. There are so many adjectives to describe the market right now, yet at an index level, nothing really is happening for the longest time.
Yes.
How do you make sense of the market right now?
Thanks for having me, guys, over here. You know, the good thing is that for the last, 6 months or so, the market's been oscillating between 24.5.
The index.
The index. The Nifty 50 is oscillating between 24.5 and 25,500 here and there. But I think what we are noticing for the last nearly 1 year, 12 months or so, is that there's a change in the market in terms of how the concentration of the markets are behaving, whether it's the earnings concentration or whether it's the stock price concentration. What we've been writing for last year or so is, unlike the US, when in India the bull markets take shape, the market becomes more fragmented. The small caps and the mid caps perform. But now we are not living in that times. We're living in the times where the concentration will rise, the mega caps, the companies with more than 3% of market share, or let's say free float market cap, or the large caps will actually play out. So we are 12 months into this cycle, folks, but I would say such sort of a cycle historically has lasted anything between 24 months to 30 months. I hope it is different this time, but to us it appears that it could actually very similar to be what has been the past 24 months or so of large cap outperforming a mid cap or a small cap.
So Kunal tracks the charts very carefully. Kunal, is there historical data to prove how many months we're already done, and when is it that we're going to break free from this range?
No, I think it makes sense because now you're seeing that this kind of a tilt and a skew has already happened. I think it's already been like 12 months so far. Give or take.
Saturday was the Nifty all-time high 1 year anniversary.
Yeah, 26,277.
4% away from the all-time high.
Yes.
4-5%.
Yes, and we've been meandering into this 1,500 to 1,000 point range
Correct.
for last, I think, 12 months.
Correct.
So I think, yes, in that sense, maybe a major part of the divergence has been shaping up over the last 12 months.
So Nitin, the question is, how do you now gear up for that breakout from this range in your portfolios?
So I think this is a stock picker's market. You have to pick right quality or right kind of stocks. Historically, what we've seen is that whenever such a cycle of concentration plays out, at that point in time, the concentration, 3 sectors, which is either pharma, IT, or to some extent even FMCG, they play out. So I would suggest that if the portfolio managers are building a portfolio of large cap names, they should look at FMCG. We're all talking and looking at improving consumption from the rural markets. IT has gone through a huge amount of downgrades. Perhaps the downgrades are behind us or the pace of downgrades. And number 3 would be pharma. I think pharma noise levels, or including that on the healthcare performance in India, the noise levels are very high, but I think pretty much very secure. So I would be in these 3 sectors. Just for a data point, IT and FMCG in Nifty 50 or Nifty 100 have one of the lowest weights ever that we've seen. So I would say positioning wise, they looking at history and today, these 3 sectors should be overweight in a portfolio manager's portfolio in today's times.
Understood. So what do you make of, is the outperformance in large caps largely going to be attributable to the mid and small caps being maybe slightly pricier? Is that what is the possible concern in that pocket?
So if I look at the last 3 or 4 quarters of returns of small cap, mid caps, or compare them to their historical averages, it's the price to earning re-rating which has been driving most of the returns of these indices, not the earnings. In the last 6 months or 9 months, we've again noticed that a lot of earnings growth differential between the mid cap, small cap and the large cap, that divergence is reducing. So if that is reducing, perhaps you will have an earnings led support to the large caps. Earning expectations means no more major downgrade revisions, whereas the multiples which have been driving the returns of mid and the small, they sort of soften or sideways for lack of earnings growth, which is materially different for a cohort as such as compared to the large caps.
So You know, if I look at your sector selection, that's largely the bottom-up stories, the ones that haven't participated in the market, or at least in the last lap. IT, let's talk about that.
Yes.
Given that IT was again so restrictive, it was all the AI dominated or the tech themes which did well, not so much the large cap service providers. So while your persistence and KPIT were relative outperformers as opposed to the Infi TCSs of the world, does that equation change? Or is it a blanket now call that you're giving for IT?
Clearly, I would say the mid caps is not what we like right now.
Okay.
So hence, many of these mid cap companies, the names that you took, we maybe are sellers on some of them.
Okay.
So we would actually prefer the large caps that way. But there would be still pockets. Let's say a Cyient has gone through a huge amount of stock price correction downwards. PB FinTech, which is another internet, perhaps, or a TBO Tech kind of names, we would prefer them. Because these are absolute good quality companies playing out, rather than saying a blanket sell on everything. As I said in the beginning, the cohort I would avoid in the mid cap, but in the large caps, I would prefer, let's say, an Infosys or a TechM, or to some extent even a Cognizant. Those were the names over there in the large cap IT.
Purely because of valuations? Or
Again, yes, valuations, because valuations, and also that reasonable earning support or the risk to the downgrades that one sees from here on could be the least in these. Because in the end, market is looking for where the earnings estimates are more stable and the downgrades possibilities are relatively lesser. So hence that could be the structure to that.
Okay, I get that premise, and I get that why the latter makes more sense, that the possibility of downgrades is lesser. But what about the possibility of upgrades at a time when you are still seeing this whole AI transition happen in the world, when you're still seeing so much uncertainty with regards to H-1B visa rules and client spends, and so many of those uncertainties out there. So why services?
So all the AI talk that we've heard of, we haven't yet seen much play out. I've seen this cycle play out 10 years back on robotic process automation. Perhaps it could be different this time. It could play out. I think the H-1B, we know that too many of minutiae that we are not aware of, that we go back and forth. Sure. I'm not saying that the risk is away from the IT services companies. Definitely the risk is there. But in the near term of 6 months to 9 months, how to position portfolios not to lose money, because to making money in the market would be very, very difficult on a market cap cohort basis. If you look at the last CY 9 months, large caps as an index, as a cohort, top 100 stocks, 1.5–2% positive at the best. 1 year it could be even lesser. But if you look at mid caps and small caps, they could be down -3, -4, -5%. And we've seen such periods play out 17 to 20. 10 to 13, 5 to 7, where large caps go sideways, -2, -3% CAGR. So you got to be in stocks where you don't lose much, you have a few winners, but you have very few losers. I would say portfolios should be today made from that point of view for the next 1 year, unless and until, as a portfolio manager, they're looking to add companies which are individual concentrated 15–20 stocks. But if you have wider portfolios, it should be lesser of losers from multiple which means earnings multiple challenges should be least. I would say that.
Got it. And consumer, right? That's the other theme you spoke about.
Yes.
You're positive with regard to that theme. Is that purely because of GST? Do you believe consumption boost in India will come from all of the policy measures that have come through? And if so, how do you position it? Because FMCG is too wide. So trying to understand what's the best way to play that.
So if you think about in the last year or so, we've been highlighting one point that historically, though the rural wages, etc. in India were holding up on nominal, but in the real inflation was actually not leading much for the growth in the real wages in India. Now for the last 4 months or 5 months, we're seeing real trends in terms of the inflation somehow being softer for the rural folks in India. So hence, rural folks premiumization, which perhaps also trickles down into names like TVS or names like Mahindra & Mahindra, they also fit into that broader consumption basket, they benefit. So I would say more rural and where people have an opportunity to premiumize, where it is less of urban or so. So hence, I would say more companies like Americo, which we've added in our recent portfolio change. Those sort of companies we would add or in the portfolios from the FMCG. So more rural focused because that's where we are seeing a lot more benefits.
So TVS, Mahindra, Marico, broadly.
Those are three big names that I can call out.
Some plays.
Yeah, those are some plays.
Understood. How should one position themselves in pharma? Because you've obviously got some headwind or uncertainty, if I can call it, maybe not headwind, with regard to tariff, which could impact certain companies. And you also have the possible viewpoint coming in that some of these companies in any case are trading at 25 times with the 2029 deadline of patent expiry. That could mean that they ought to, or some of their parent companies are actually trading at single digit multiples, while the supplier companies sitting out of India are trading at 25 times. How should one try and rationalize that, and how should one play pharma in your opinion?
So when we talk about pharma, we talk about the larger index of pharma and healthcare both put together.
Sure.
Within that, I know that there are risks around the regulator commenting about pricing of the healthcare. I would say hospitals is what we would prefer.
Okay.
We've today changed our portfolio and we've added a company like even HCG, small cap, mid cap, one of the ideas in the portfolio, which is more large cap dependent. I would say hospitals and some companies like even Sun Pharma, though we know that the regulations announced over the weekend perhaps impact Sun, but there's a lot of uncertainty over there. So we would prefer companies like Sun Pharma or a Torrent, those sort of companies in the pharma space, we would prefer them. Very well knowing that there's a lot of noise around the tariffs in the US right now. Well, thematic would say CDMO is the best thing in India. But remember the valuations that you're looking at CDMOs also right now, which actually are too punchy. So hence in a market like this where valuations and growth, you've got to find the right balance where the expectations are balanced with the multiples. And hence I would say pharma, companies like Max, companies like, as I said, HCG, companies like Sun Pharma, Torrent, they make more sense to us right now. Even if some of them are punchily priced, their earnings have a less risk of downgrades.
Right.
That's the central thesis.
Got it. Nitin, last question, and I've been told that I need to make this really quick, so I'd request you to do that. But very tough to close a conversation like this without talking financials, right?
Yeah.
And you said that you're playing contrarian. So what's happening there? What's the thesis?
Yeah. Again, I think in the banks, I think last 1 year the returns have been very good. And perhaps what we are seeing right now is you are looking at downgrade risk rising. Look at the last 4 months or so in India. You've seen most of the downgrades happening in the bank sector only. NBFCs are still not looking at most of their input cost of material, which is money, coming down overnight. There are still concerns around the earnings and the wages for people. Remember, just look at what's happening for the last 5 quarters of employee wage growth for NSE 500 languishing at about 6 or 8%, which means that credit runway or credit growth is not crossing to mid-teens, number one. At the same point in time, the credit environment is not turning around, whether it's microfinance or otherwise. And because of that reason, I would say the banks will see 1 to more quarters of earnings downgrades or perhaps reductions. And that's why we are not buyers on that right now. Change our calls a few months back.
Okay, Nitin, on that note, we let you go. Glad
Thank you.
that you could make it to the studios.
Thank you.
Thanks.